founders don't realize the impact of this and what it means to raise capital from a large multi-stage firms at seed versus, a seed-focused fund. And the assumption is what you articulated. Well, they have a lot of money. Therefore, if I hit a bump and I need another $1, $2, $5 million,
it's just a small check.
It's a small check, no big deal. They're going to support me. And it's actually exactly the opposite. The large firms, more or less, they're buying an option on your company, right? If it works and it works quickly, they can deploy more capital behind it. If it's like hard and it takes a long time, they want to move on to the next thing. I actually think seed dedicated funds are 10 times, 100 times more likely to continue to work with you and support you and try to find a way for you to achieve that next milestone, product market fit, next round, whatever it is, than a large multi-stage firms. And really that is a part of my thesis, are that smart founders who realize that trying to raise these rounds from the large funds is not the right place for them to be raising capital at seed. They're in the business of deploying capital. They're in the business of managing funds.
A good way to think about it is the smartest founders want investors where their business is also a material percentage of that investor's business as well. Welcome to The Peel. I'm your host, Turner Novak, founder of Banana Capital. Today's guest is Villi Iltchev, founder of Category Ventures. Villi invests early in enterprise software startups, and he's done it longer than almost anyone, building Salesforce's original corporate venture arm.
Salesforce at the time, 2009, was bigger than the entire SaaS ecosystem combined.
We get into how San Francisco and Silicon Valley have changed over the past 30 years and the opportunity he saw to start Category.
Balance of power definitely shifted in favor of founders during that time period, and a lot of VCs didn't realize that.
The biggest mistake of his career and the advice he gives all young people.
The thing that matters the most is relevance. Don't worry about title. Don't worry about money. Worry about working at a company that matters.
His advice for founders selling their company and why unit economics and profitability always matters.
You should never lose sight of the fact that you're building a real business. When capital gets loose and things are hot, people lose sight of that and then bites them.
How developer tools went from terrible to amazing businesses, and the mistake that almost killed GitLab after he invested.
And so Sid decided to broadcast on YouTube how they were dealing with the recovery.
And his advice to young VCs.
A lot of younger investors that get into the business don't quite have the understanding of why or how it is important for their career going forward.
A quick thank you to Samal Shah, Nakul Mandan, Trip Jones, and Alex Conrad for their help brainstorming topics for Villi. A reminder, I publish 2 episodes of The Peel every week, exploring the world's greatest startup stories, just like this one. Let's talk to Villi. Villi, welcome to the show.
Thanks for having me.
So I thought a really interesting place to start. I usually don't get into people's stories to begin the podcast, but I think you have an awesome one. I saw you tweet before about you were once an illegal immigrant. Can you just tell us the story?
Yeah, that was a long time ago and not in the United States. When the communist war in Bulgaria collapsed, so did the economy, and things got really bad. That's 89, 1990, 91. Things were really rough in Bulgaria. There was lack of the basics. When the state collapsed, everything else collapsed. And I had a pretty good childhood in Bulgaria. My parents were engineers. My dad worked at the Academy of Science. But when the war collapsed, they lost their jobs. Everybody lost their jobs. And crime was off the charts. It was a tough time in Bulgaria. And so in the spring of 91, my parents decided to immigrate to Greece. And we had a 3-day visa to go there. We actually separated into separate cars, my mom and my sister, my dad and I, so that people wouldn't suspect we were immigrating if we were all together. And so we crossed the border, went to Greece. I have some Greek heritage too, so we have some family in Greece. And so we just never went back home. And we stayed there illegally. I was there illegally before I came to the US for 18 months. My parents stayed there for 6 years afterwards, supporting me. But yeah, I was illegal there, which is part of the reason I came to the United States. I was going to a Greek high school. I learned Greek. But there was just no future for me there. I couldn't go to college there. I couldn't do anything. I was in 10th grade. I was 15. And so my way out of that situation was to apply to a bunch of boarding schools in the US and the UK and see if I can get a scholarship somewhere. And so I went to the US consulate, made copies of random boarding schools in the States, and sent a bunch of applications. And sure enough, like a month and a half later, I got a letter from some random boarding high school in Georgia.
Did you remember applying to that one?
Not really. I wrote like random letters. And so they offered me a large financial aid package. And I went to my parents and I asked them if they would be willing to send me, which was a big ask. You know, my dad was digging ditches, working in construction. My mom was working as a maid. Both of them are highly educated engineers. You know, I really wanted to, come to the States and get out of that tough situation we were in. And so my parents agreed. And so I came here when I was 16 and never went back home.
How did you do college?
I was completely ignorant at the time. I, finished my junior and senior year in high school here. When it came time for college, my college counselor, said, hey, you're a good tennis player. So I missed that part of the story. When I was a kid, I played a lot of tennis. I was a good tennis player. And he said, would you like to try to play tennis in college? And I said, sure, I need a scholarship. I can't afford to go to college otherwise. So I need all the help I can get. And so my college counselor basically applied to a bunch of random small private colleges in the Southeast on my behalf. And so this small college in the middle of nowhere in South Carolina accepted me, gave me a tennis scholarship. I never visited the college before I decided to go.
Okay.
I mean, I didn't have a car. I didn't have anything. I was at a boarding high school. So
Georgia, and this was in, you said South Carolina?
That was in South Carolina. So my college was literally in the mountains of North Georgia, 20 minutes away from my high school. From Tennessee, North Carolina, and South Carolina, right where they all meet there in the corner, in the middle of nowhere. And so, so that's how I went to college. And, I think the first 10 years of my life in the States, that was before I even had access to a computer, were just me in complete ignorance, stumbling around and getting by and getting through whatever the next milestone was.
Yeah, it seems like falling forward, though. Like you were always like moving ahead and you were at least not getting trapped.
I wouldn't describe that period as a purposeful, period in my life. I was a kid with nobody here and nobody to guide me, just getting through whatever the next college was the next milestone. So I went to college. When I was graduating from college, same thing, complete ignorance. What am I going to do now? I need to find a job. And I ended up going to grad school by accident. I majored in philosophy, took a bunch of accounting classes too. And my accounting professor said, asked me one day, what are you going to do when you graduate? And I said, I don't know. I need to go find a job. And she said, you should go to grad school. And I said, well, I can't afford grad school. I'm here on a scholarship. My parents don't have money to send me to grad school. She said, oh, you're a good student. You don't need money to go to grad school. They'll pay for it. And so she literally drove me to Clemson University. Like the following week, I met the faculty. I applied. And sure enough, got a fellowship that fully paid for grad school. And off I went, not because I wanted to get a degree in accounting, not because I wanted to be an accountant. It was like the next thing I could do short of getting a job. And I was not, it would have been hard for me to get a job because not a good school, just graduating. I was on a student visa, so it would have required somebody to sponsor me. I didn't have anything unique about me or unique skills to warrant somebody to sponsor me. And so off I went to get a graduate degree in accounting. And I would say it was around that time I started to figure things out. I was graduated top of my class. I had job opportunities now with people willing to hire me and sponsor me on an H-1B visa, which is actually quite topical these days. And the rest is history. I kind of stumbled my way through my childhood here in the States. And then I was a bit more purposeful after that point. Prior to that, I just didn't know what I was doing. I was completely ignorant.
Well, I mean, you're kind of growing up in, I don't know if chaos is the right word, but it's not like a very structured, simple, easy environment. Like there's a lot of challenges, it sounds like. So it's probably hard to be purposeful when you're just trying to survive.
I was just on my own. I just was on my own, didn't have any parental figures or mentors to guide me through this. It's one of the bigger regrets I have because I was a good enough student and a good enough tennis player to go to a really good college, for example. I could have played at a good university and had a better, I just didn't know. I had no idea what I was doing. Funny enough, my wife has the same story. She grew up in Florida, played tennis, first kid in her family to go to college. She's smarter than me, more talented and all that. She could have gone to play tennis and go to a great university somewhere. And she didn't have anybody to kind of guide her because her father was a fireman, her mother was, a hairstylist. And so she just didn't have guidance either. And we both ended up at this like tiny little college.
Is it Erskine?
It's called Erskine College, okay. In the middle of nowhere in South Carolina.
I think I saw student body was like 900 people.
Oh, it's tiny. It's tiny. It as I said, it's like a regret I have. I had a good education. I had a good experience overall. But if I could do it over again, I certainly wouldn't choose that path.
And then you, right out of school, so you're like, okay, I'm doing accounting. I've got this master's degree in accounting. I think you did a little bit of like public accounting, it seems like, and then you got an MBA? Very
little. I actually, after I finished the graduate degree at Clemson, I had an opportunity to join the broker-dealer inside PwC. So PwC at the time thought they can have an investment banking practice. And we did a lot of infrastructure investment banking work. So a lot of project finance and infrastructure investment banking. So think toll roads, power plants, bridges, or even prisons, all of these like large, massive infrastructure projects that could be financed on a project basis.
So these are like cash flow positive infrastructure projects.
Yeah,
like,
for sure.
That's a good thing for cities to be thinking about.
And we did a lot of work with like multilateral agencies in DC, basically building infrastructure in developing economies or doing privatization work. So for example, like the government of the Czech Republic would want to privatize their electric utility distribution assets. And so we would like help them and structure that process. To make sure that privatization is successful. That was year 2000. And so the California power crisis was going on at that time. And so there was a lot of actually investment in energy technology as well. And so because we knew energy and power, we also ended up doing a lot of advisory work and working with startups at the time, building Stirling engines or what is now standard, like remote monitoring electric meters and stuff like that.
And this was also when the dot-com bubble was kind of happening or building and then pop.
Yeah, and funny enough, I was really into it at the time. I was reading all of the tech blogs at the time and super fascinated with what was happening in the world of software, even though that wasn't like what I was working in or focused on at the time. I was really into it. And I spent 3 years doing investment banking work. And then my wife had graduated from Darden University of Virginia, the business school. She went before I did. And we wanted to stay together. We were living in DC at the time. And the best business school nearby, driving distance, was University of Virginia.
Oh, really? How close is it to
It's
DC?
like 2 hours.
Okay.
It's in Charlottesville. And so that's how I ended up at University of Virginia getting my MBA.
Okay. And then after that, you worked at Merrill Lynch for, I think it was like 4 years or something?
Yeah. So still an international student. And so when I was graduating from Darden, the only career paths for me, basically companies willing to sponsor international students on an H-1B, were the consulting firms and the investment banks. So in a weird way, like my career path was chosen for me. I couldn't go take any job. I didn't want to be a consultant or an investment banker. But
you had to.
But those were the only two jobs I could get where an employer was going to sponsor me. And so I ended up having an opportunity to join Merrill Lynch here in San Francisco doing technology investment banking. And that's what brought me to San Francisco in California in 2004. It was a better place for me. It was more aligned with my interest in tech and software specifically. It was a better place for my wife, who was a product manager. And so that's how we came to San Francisco 20 years ago.
How has San Francisco changed since then?
It has become certainly more tech focused and dominant. Like at the time we came here, the technology ecosystem was mostly in the Valley. And San Francisco was a much more diverse town from an industry perspective. I'm not saying better or worse, it just was. Like a lot of the, McKesson was still based here. I think McKesson ended up moving out of town. And so it was just more, Bechtel, a large construction company, was based and founded in San Francisco. There was, the retail and brands and furniture. It was just more of a...
I think like the Gap was here.
The Gap was here. And so I think the big change over the last 20 years was just the emergence and dominance of technology. In San Francisco, a lot of tech ended up moving from when creativity... We were building a lot of infrastructure, semiconductors, optical equipment, and stuff like that in the 90s here, where software emerged and creativity and design and user experience started to drive a lot of the value. Turns out a lot of those people actually wanted to live in San Francisco. And so I think a lot of tech moved to San Francisco over the last 20 years. So it's changed in that sense. In many other ways, it hasn't really changed much. I don't know that it feels much different than when I, arrived 20 years ago. The homelessness and drug addiction that we see is more of a recent phenomenon over the last 5 or 10 years, certainly with fentanyl arriving to the States. That is certainly a change for the worse, and I hope we can address it because it's really sad. It's really sad.
I walk through, I live in Ann Arbor. There's a little bit, but it's not the same. You walk through downtown San Francisco, and I feel like the things that you walk past, you wish that was not happening.
It's very depressing. These people are really sick. It requires a massive endeavor in policy to address the problem. It is certainly a local problem. A lot of it is also a national problem. Like drug addiction is in Ohio and in Michigan and everywhere. Here it's in your face. You see it. You can't escape it. Like because of the policies we have here tolerating a lot of the open market drug dealing, et cetera, it attracts a lot of these people who are sick, by the way, but we certainly need a more focused and policy and driven approach to clean this up and help these people. It's really sad because these people are dying on the streets and we are kind of numb to it. But I think that's been a change that it just has made the city less livable. It's really sad what's happening. But again, I'm optimistic. I've always been optimistic. A lot of people during the pandemic went to different places and would debate what's the best place to live. And I still find San Francisco to be the best place in the world for me to live. I love it here. I love the ecosystem. I love what we're building, the impact we're having. And so I'm really happy here, but I do want San Francisco to be a functional, town. We have an enormous budget. I was reading a stat yesterday that we have a $12 billion budget for a town that is 800,000 people.
Yeah, I was going to say the budget to population ratio is very favorable.
It's off the charts. You have all the money, but government is not working for the people. It's dysfunctional. It's corrupt. we're not addressing our challenges, whether it's housing or drug addiction, et cetera. So I'm really hopeful that we have made a turn here, and San Francisco will achieve its potential of being this amazing liberal city, but a functional city that allows lower income and successful high income people to live and raise their families here.
Yeah. And well, speaking about reaching their potential, you mentioned something earlier about like kind of the rise of software creativity in San Francisco. The company you joined was Salesforce. They were kind of like at the front of kind of SaaS and software. How did that come about, getting that job from investment banking?
After spending about 4 years in investment banking, I had gotten married. So now I had a green card and I actually could, be more, explore and actually go get the job I wanted. So I decided to leave banking in 2008, a few months before the financial crisis, which was great timing. And I called my two best clients. I had done a lot of work for HP and I had done a lot of work for Salesforce. And
so I guess I'm curious, what kind of work were you doing? Because when most people think of investment banking, they think like you take them public. Those are both public companies. Like, what were you doing with them?
Well, so a lot of advisory work for Salesforce, both on things they were considering acquiring, though they hadn't really acquired anything at the time. But you can bet a lot of people wanted to acquire Salesforce. And so I'm not going to talk about anything that's not in the public domain. But, people wanted to buy Salesforce, have always wanted to buy Salesforce. And funny enough, there was always a price. Benioff was a very commercial and rational person. At the right price, he would have sold the company, but it was always it was always next year's price. And people were always, kind of missing the forest for the trees and penny wise, and would walk away over pennies.
So like he just wanted the extra 30% price appreciation that he'd get if he sold next year.
Yeah, basically.
Interesting.
And so we had done a lot of work with Salesforce over the years, kind of advisory work. Same thing with HP, both on acquisitions. We had advised them on the acquisition of Mercury Interactive and other things, any equity offerings or debt offerings they wanted to do. We had done all that work for them. So anyway, I called my two best clients, Salesforce. This is like 2009. They were like, Villi, we're a tiny company. We don't do anything interesting. We don't really need somebody with your skill set. Let's stay close. And HP said, would love to have you join us. And so I joined the strategy team at HP. My role was basically to help lead their enterprise hardware business, so servers, storage, and networking equipment.
Did they still have printers? Or was
they had the printing business as well. That was a $30 billion business at the time. They had four businesses. They had the consumer business, the printing business, their software business, and their hardware business.
What was their hardware?
Hardware was server, storage, and networking equipment. So they competed with Cisco on like edge routers, and they had their server business and they had their storage infrastructure business.
How big was HP at the time?
Well, so that was like an amazing opportunity because HP was on top of the world at the time. It was one of the largest companies in the world, like $100 billion in revenue.
Oh, wow.
Massive.
I didn't hear about HP.
Yeah, massive business. They came out of the financial crisis in unscathed. They were just in such a great spot, but really poor leadership. You could see at the time I was there, the short-mindedness of the leadership team at the time. Mark Hurd was the CEO who passed.
What mistakes? Cost
cutting, not investing in R&D. He completely gutted the R&D organization. And basically HP, which was what you thought about Silicon Valley in terms of innovation and engineering, and they had the labs, completely gutted it. And at the time, as US was rising, we had a $30 billion servers and storage business. Oh, wow. And I would ask basic questions like, if customer wants to buy compute or storage infrastructure, maybe they want to buy a box, but maybe they want to buy a service. Why can't we do both? Why do we need to sell them a box? let's rethink this business.
So why? What was the answer or the rationale?
It's not what we do. It was just
too small of a market at the time.
Small market, cannibalizing our existing hardware business.
Did it have lower margins?
I mean, the irony was, and I remember seeing the data back then, because scale was so important to HP, they were selling hardware, servers and storage at zero or negative margin to their top 30 customers, right? So they can make money on the long tail.
Just because they have so much like economies of scale. That
the economies of scale were so important that they were willing to take a loss on their largest customers. Anyway, so how I got to Salesforce, I got a call about 15 months later from Salesforce. And the guy that used to run the corp dev team there, John Samorjai, an amazing boss, amazing guy. He basically said, "Hey, Villi, we actually want to get more active on the strategic side. Want to build a proper corp dev function, start to take advantage of the opportunities we have in our ecosystem to start flexing our muscles and be more strategic."
This was emerging out of the financial crisis, probably.
Yeah, 2009. 2009.
Okay.
And we want to build an investment arm. We want to start being more strategic with how we deploy capital and building relationships with the startup ecosystem, et cetera. Would you consider joining us? And in a weird way, that was probably the best thing that happened to me career-wise, because Salesforce was such an impactful, relevant company at the time. Salesforce at the time, 2009, was bigger than the entire SaaS ecosystem combined. It had about $1 billion in revenue. You add all the SaaS companies at the time, you couldn't add up to $1 billion in revenue.
Oh, really? And Salesforce was public.
And Salesforce had gone public. And so they were just an extremely relevant, forward-thinking company. So right leader, right space, right time. And back to my interest and passion in software, I could see the writing on the wall that, SaaS as an industry, as a way of delivering software and consuming software, was extremely disruptive to the software industry, and that's where the puck was going. So it was just a great opportunity for me to join Salesforce very early, public company, but very early in the emergence of software as a service, and kind of ride that wave. And that was just an amazing experience. We had a front row seat and everything that was going on in the software ecosystem at the time. You
mentioned to me before, it was like shooting fish in a barrel, like just the experience.
Yeah, I mean, we started slow, right? We didn't have the muscle yet. And so we were building it both on the investing side and the corp dev side. Yep. But you were sitting kind of at the top of the hill, looking around and thinking like, what are the relevant spaces around us? Where's the puck going? What are the emerging markets in the software ecosystem? Like you look at Dropbox and content management and Box, that market didn't exist, right? Like Dropbox started with like a file sync tool that nobody even knew what that was, or even could imagine that would become like a real enterprise software company.
Yeah, I had Aaron at Box on the podcast a couple months ago, and he was like, the category didn't exist.
It didn't exist. And so like I would meet with Aaron and these like amazing founders at the time. And because we were such a relevant company in the space, most of them, if not all of them, there were only like 2 founders I can think of that didn't want to actually take capital from us. Toby at Shopify was one of them.
Oh man! Why did he not take money?
And the other one was who wouldn't return my calls. I think 1Password wouldn't return my calls. So I forget. But basically, we had the ability to invest in anything we wanted to. So and we took full advantage of it. We invested in HubSpot and MuleSoft and Anaplan and Adaptive and Zapier, Box, Dropbox, like. After I left Twilio, like they did an amazing job, and founders wanted to engage with us. We were a good partner. We were a good player in the ecosystem, and it was just an amazing program we built, and they scaled it to the next level after I left. But it was just an amazing time to be at Salesforce. And
so, what did you learn from Salesforce? Like it sounds like you got to see a lot. You had good access. Any big lessons?
Yeah, I mean, I learned a lot. I mean, as I said, I had a front row seat at like everything that was going on around us. And, whether that is all of the planning tools or content management, all the ETL tools that were happening, the platforms, like I ended up leading the acquisition of Heroku, which actually ended up leading me to GitLab, many years later. But like, we had a front row seat, and I learned so much about the industry and software and the business models and what worked and what didn't work. And so it was just a really amazing experience. Software as a service at the time was such a nascent business model. Nobody knew how to value these things, how to think about the business, the unit economics, what's the role of services in a company like that. If you look at like traditional enterprise software, you got all of the value of in a sale up front, and then you would sell the customer a maintenance contract. That was approximately for 20% of the value of the initial sale, and that was your recurring stream.
Would you resell more licenses later when
and you could sell more licenses, but most of the value was sold up front. The reason SaaS was so impactful and kind of took over traditional enterprise software was it was a much friendlier delivery model for the customer. It lowered the cost of the upfront cost of buying software. It kind of democratized software so that now small businesses had access to, software that was previously only available to the largest companies.
Because the cost came down?
Because the cost came down of adopting software. You don't need to buy a server rack and put it somewhere in a closet and then spend like a year customizing or implementing it and hiring an army of service providers and consultants.
You have to pay for all that, right?
Like you had to pay for all that upfront versus now for $20 or $50 or $100 per employee per seat, you can get access to world-class software that was previously only available. And so it significantly lowered the cost of software adoption and deployment for the customer. It significantly lowered the switching cost for the customer. And so now the vendor is incentivized to continue to add value over time, or you will churn. Versus previously, all the investment is up front and the customer was incentivized to stick with it for as long as they possibly could. Now, unless the vendor is continuing to innovate and add value and make the software better, customers were going to churn. So it was just, I don't know that SaaS is actually a better business model for the vendor. Again, like you have to spend the same amount of time selling it and you recoup that value over time.
You have to continue supporting that.
And supporting it. So the unit economics in SaaS are not necessarily better. It's not necessarily a better business model for the vendor, but it is certainly a better business model for the customer. And because it was a better business model for the customer, that's what really allowed SaaS to take over and scale.
To just increase the market size.
And that's the other thing is I remember reading, when I was at Salesforce in 2009, 10, 11, 12, I remember reading research reports from like Gartner and whatever. And they would say that the size of the CRM market, which includes support, sales and marketing, would be like $7-8 billion. I was like, how does this even make sense?
How much revenue does Salesforce have today?
I mean, when I joined it, or today, it's like 30-40 billion in revenue run rate business. Yep. So yeah, it expanded the market enormously. And that was the impact. Previously, software was a small niche market available that sold to the largest companies. And now, a business the size of one probably uses, 20, 50 applications.
And that might have been like
business.
The one server purchase is now 20 different products.
Yeah. So that's, so lots of lessons there, both industry and markets, business model. It was just a great place to get educated and smart on enterprise software.
You mentioned specifically you angel invested in Airtable. Is there a story there?
I had met Howie Liu, the founder of Airtable, I want to say in 2010, maybe 11 timeframe. Yep. He had started a company called eTax that was basically creating a social profile for an individual. So how do I take everything that we know about Turner, his LinkedIn, his Facebook, his Twitter profile, his any other, and enrich it into like one profile of who Turner is. Automatically, so that if I want to sell something to you or kind of look you up, I have a better sense for who you are, the things you care about, so I can do a better job selling. So he had started a company early on, and we acquired his company because we wanted Salesforce to be that place where a contact is enriched and you can see the full profile.
That sounds like a pretty good feature, like in the Salesforce.
Exactly. And so Howie ended up joining us and building that inside Salesforce. And he ended up leaving about maybe a year or 18 months later. And he knew he wanted to start another company. He didn't know what that was going to be. We were very close. We were friends. And he became a bit of a Renaissance man. He went to design school. He traveled, really kind of trying to explore and think about like, what do I want to do next? And he had a lot of ideas. I remember meeting him at a bar. We would like catch up once a quarter, meeting him at a bar, and he was going to start a photo sharing app. And he was showing me this amazing demo he had built. And I'm like, I'll invest, I'll fund it. Like, he's the type of person that is an amazing engineer, designer, and business person in one package.
That's
and it's just
combination.
Extremely rare to see. Like, he was just a special person. And I didn't care what he was going to do next. I wanted to be an investor in whatever he was going to do next because he was really special. I even like tried to convince him to start a company with a friend of mine. I remember being in my kitchen trying to talk him into building a dating app for friends and friends dating on Facebook.
Okay.
And he was kind of intrigued and liked the idea, but that's not really what he wanted to do. And so maybe at some point in the future, like 6 months later, he ended up calling me. He said, Force.com is such a massive market, the ability to build your own application, such a massive market, but Force.com is just not the right product for it. It's really hard to use. You need to know how to code. You need to know all that.
I've never even heard of this before.
Force.com is like the Salesforce app building platform.
Oh, it was a Salesforce product?
Yeah, it still is. It's a massive business. It's what made Salesforce successful. It's basically the ability to build custom objects and create your own application, build your own workflow. So Salesforce was very early on. What made them successful really is the ability to create custom objects, to build your own workflow and application inside Salesforce. And so people use it in a very, CRM-ish ways, but people do all kinds of things with Salesforce. Customers extend it into the entire business process. And so he thought like that robust database in the cloud, which was Force.com, with a much friendlier user experience on the front end, Airtable, a spreadsheet, a grid that everybody knows how to use is the right way for him to disrupt that market. And his insight was that, if you look at 90% or more of what spreadsheets are used for are to create lists. Basically, people use spreadsheets as a database. Oftentimes, most of the time, the majority of the time. And so he said, I'm going to, build a app building platform, but in a way that is accessible for any user with a very familiar user experience. And so, as I said previously, I didn't care what he was going to build. I wanted to be an investor in his company. Yeah. And so I said, this sounds great. Like, I want to invest. And so I ended up being an angel through that relationship and friendship I had with Howie very early on. And yeah, he's just an extraordinary founder and individual.
And so this was like 2013 maybe was when this all happened?
Yeah, I think 2013 is when he started Airtable.
And then you did, it seems like you did two other really shorter kind of corp dev stints. Were those interesting?
After Salesforce, I had an opportunity to kind of take the next step, as I thought, in my career, which is I wanted to be an executive at a public company, become a Section 16 officer, which is like the 3 people that kind of run the company.
Sounds fancy.
Sounds fancy.
Yeah.
And so I was recruited to be one of those 3 people that ran the company at LifeLock, which is an extraordinary business, by the way, just an amazing company, an awesome business. I kind of consider that a mistake in my career, to be honest with you, largely because while it was an amazing business, an amazing career opportunity for me, all of that, LifeLock wasn't a relevant company in the tech ecosystem.
I think of my grandparents or something.
Exactly. And what I quickly realized is that I may be very successful and like well paid and all of that. It was in many ways a career dead end because I was becoming less relevant to the ecosystem the longer I stayed at LifeLock. And so kind of very quickly, I had this thought that I need to, if I want to have a career in tech, the thing that matters the most is relevance. And I give this advice to young people that come into the tech ecosystem. And my advice is, don't worry about title. Don't worry about money. Worry about working at a company that matters, that people care about, that is pushing the envelope or innovating in different ways. That is the best place to be in the tech ecosystem. And that's what you should optimize for. And so, long story short, I had invested in Box when I was at Salesforce. I knew Aaron really well. I admired him. And so I reached out to Aaron and I said, I think I'm going to leave LifeLock. If there's an opportunity, I would love to talk to you about it. And so Aaron very quickly kind of jumped on it. We met up for coffee. It was the year before they went public. And so
was this the first kind of attempt, or was it when they actually did it? Because remember, I remember they like failed IPO, but it was like they waited a while.
They waited a while because I think at the time kind of there was this switch of growth at all costs to like we actually care about unit economics.
Yeah, I'll throw the link to that episode in the show notes if people want to listen. But it was kind of like they had like got the company set. He thought they were in a great spot, and then when they posted the S1, people were like, what's going on?
Yeah, you're burning too much capital, unit economics upside down. Yep. So they had to spend like 12 months or 10 months, whatever it was, to improve the unit economics and basically show people that this is not just a fast growing company. It's actually a good business too. It's a profitable business. The unit economics make sense. And actually a lot of founders make this mistake. A founder I worked with, I remember making the comment to me that, well, last year everybody cared about growth at all costs. Now people care about unit economics. And I'm like, hello, people always care about unit economics. That never changed. Like you should never lose sight of the fact that you're building a real business, a company that eventually needs to be profitable and successful and thriving. And so I think when capital gets loose and like things are hot, people lose sight of that and then bites them. That's never a good thing. Like it's never a good thing for you to really get the unit economics so far away from you that it's going to take you a year or 2 or 3 to recover. And actually that recovery process is really challenging. It's never pretty. It rarely works out well, actually. In the case of Box, yeah, it's really hard.
What makes it so hard?
Well, it's easy to put fuel in the fire behind positive unit economics, right? It's very easy to invest behind what is already working. When you have poor unit economics, by definition, now things are not working very well. Your CAC to payback is like north of 2 years. You know, you're very inefficient at acquiring customers and growing. And so trying to get back is actually really hard. It's really hard to go back from 2-3 years CAC payback back to like a healthy place. It takes years and it's not pretty, right? It's just a very challenging things. Once companies get into this mode of spending money and solving problems with money, as opposed to creativity, nimbleness, like be efficient, like solve problems with, better product or whatever, you can always throw money at the problem. And I think when money is loose, people end up throwing money at the problem. Every problem they have, they hire more people. So it's really hard to kind of get back to being a nimble, efficient, good business.
How does it get to that point though, where your CAC payback is 2 years or 3 years, but people are giving you more cash and you keep investing in something that might not be working? Like, how do you usually see that play out where you get to that point even to begin with?
I mean, we saw it over the last 4 years, right? And we kind of go in these cycles where when cost of capital is really low, your willingness to extend your CAC payback grows, right? And so when capital is loose, low interest rate environments, people are willing to, because capital is cheap, to basically lend money to their customers in some ways and build a less efficient company over time. So anyway, I think Box, when I joined, they were on file. They hadn't gone public yet. So I joined after they had filed. And my role there was to basically sit between the product team, the customer, and the sales team and kind of figure out really what business are we in? What are we building here? Are we building a content management company? Are we building a collaboration company? Are we building a security company? And so depending on how you define what you're building in the long term, you're going to be able to make much better decisions in the short term around what contributes to that long-term goal and what doesn't, without having that long-term horizon. It's really easy to justify distractions in the short term because some customer wants this feature or that feature. But if you say, no, we're building a content management company, and this collaboration or this thing is just not in scope, it doesn't contribute to that long-term goal. And so, my role at Box was less kind of traditional corp dev, like investing or buying companies. It was much more working with Aaron and the team there to help set long-term strategy.
That makes sense. I know you said earlier you had acquired a couple companies. Are there any things that founders should think about when they want to sell or it's a time to sell? Like realistic expectations on getting bought or selling my company?
There's a lot we can talk about this, and that's probably an hour-long conversation in and of itself. I would say the biggest mistake founders make is to assume that somebody would want to buy their company. In most other industries, for an asset, there's a price. You may not like the price, but because most other industries are kind of cash flow based, there's a price for just about any asset, real estate and whatever. There's a price.
Yeah, like it generates $1 billion or $1 million in cash. Is that worth paying in 2 times that?
Exactly.
Times that, 20 times that.
And you can debate about price, but usually there's a price for assets. Yep. In tech, that is just not true. Like nobody gives a shit about your product or what you've built. There is not necessarily interest in your product. It's hard to acquire, it's hard to integrate it, it's hard to extract value. So there's just a much less efficient or transparent market when you try to sell your company. It requires that somebody actually cares about what you've built and actually wants to buy it and can see how they can integrate it and build something around it or with it. And so generally speaking, what I tell founders is that there is no buyer for your company, and you should assume there is no buyer for your company, and you will never get acquired. And actually that's a separate, we can talk about that a little bit. That's in a way how I got into venture. I had this thesis that there are no buyers for these assets. Nobody cares to buy this or that company. And so it's actually really hard to sell your company in the tech, in the software space. And so kind of that mindset of building something useful, building a good business, in some ways, you can say I'm a bit old school, but I think that matters. It helps founders be in control. It helps them control their destiny. It helps them like decide when and how they want to sell their company and to whom. And so I try to preach that very early on, like try to build a good business, try to be in control. And so what can founders do? Well, the first thing is don't assume anybody cares and don't assume anybody wants to buy your company. And you should assume if your business fails that nobody's going to buy your company. It's zero.
So what should happen to change that assumption to where it looks like now somebody does? Like where's usually a case?
Well, so again, like companies are bought, they're not sold, right? To the extent we see M&A happening in software, it's like people have built something useful, they find somebody who values it and they're willing to pay money for it. But again, companies are bought, they're not sold. If you have to sell your company, by default, you're in a very disadvantaged position. You're basically looking around for somebody that cares. And that's not a good place to be. And so, yeah, I think software tech in general is really opaque when it comes to acquisitions.
You actually made a transition from corporate side to venture. I think before you did that, you actually thought about maybe starting more of a PE styled software fund.
Yeah.
Can you just talk about that like arc of making that decision?
So at the time, I was probably kind of the most experienced SaaS buyer. I would say investor, but say buyer at the time. And I had this thesis. I wrote a blog post. You can read it on my blog, why SaaS is not going to consolidate in the same way that traditional enterprise software did for a variety of reasons. It's much easier to integrate, traditional enterprise software. Again, you were selling CDs, that a customer would deploy into their data center and then hire an army of consultants to deploy it. You could buy this. It becomes a go-to-market game. You could cut the R&D function to zero and save a ton of money because, again, you're selling CDs. The customer is not going to know for 5 or 6 or 7 years that you haven't invested $1 in your software, in your application. Yeah. And channel mattered a lot. In SaaS, that was not the case. The minute you stopped investing in your product, the customer sees it. The minute an acquisition happens, the customer asks you to sit down with them and talk about the roadmap. What are you going to do with this asset? How are you going to continue to invest in it? Switching costs are lower. And so much harder to integrate these companies too, right? You end up supporting completely separate, technology stacks, top to bottom, that are never going to converge, right, with your current application. So very hard to cut costs, very hard to impact the top line. And so I had this thesis that software is not going to consolidate, SaaS is not going to consolidate, and therefore these companies will need to exit at some point, and therefore I think there's going to be a role for private equity to play here. That's before Vista and Thoma Bravo and any of those.
Were they around then, or were they just like?
They were around. They were doing like smaller, like niche, mostly like traditional enterprise software deals. They would like Vista started buying like random stuff. They would buy like software for nuclear power plants, that type of stuff, like niche stuff. That's how Vista started. Nobody was doing like large SaaS deals on the private equity side at the time. And I had this thesis, like somebody needs to figure out how to make money off of these assets. I didn't know how, but somebody had to figure it out because it was clearly going to be an opportunity. And certainly Vista and Thoma and all of the private equity firms have become large SaaS buyers since then in the last 10 years. But I was kind of going around like talking to different private equity firms, some of the large venture firms about this thesis and like how do they think about it.
Because you were kind of looking like you might be their exit liquidity in some cases.
Yeah, that's my point. Is like I would look to buy these like, $20 to $80 million in ARR software companies. There's long list of them. The VCs are tired. They've been in it for 10 years. They're never going public. They're never getting acquired. So what happens to that asset? And at some point, I thought there's going to be an opportunity for somebody to buy them, figure out how to make money off of them, roll them up into roll up all the .NET companies into one, whatever the thesis was. I thought there was going to be an opportunity. So I was going around talking to the different venture firms, the large ones. Some of them had buyout practices, sharing kind of my thesis. And out of those conversations, one firm said, Villi, we share your thesis, but have you considered venture? Or we think you're going to be a good venture investor. You know the ecosystem. You've done a ton of investing work in the past. We think you do good as a VC. I was like, I haven't thought about it. I've done a ton of investing, but never thought about it as a venture as a career. And so the first thing I did was call a bunch of VCs I knew, friends, people that had sat on boards of companies I had been part of, and just ask for advice. And, a lot of the people I talked to said, I think you should do this. I think you'd be great. And in some cases, by the way, you should join us. You should talk to us. And so kind of out of nowhere, I ended up talking to kind of half a dozen of venture firms. One of those firms was August Capital, which led me to August Capital in 2016. And at the time, I couldn't have asked for a better opportunity to start my career in venture. August was such a, storied, amazing firm, great legacy, great history, people, all of that.
What's the real quick story, just for people who are not familiar with August at all?
Well, August was one of the great venture firms, kind of historic firm. I think it was started in the mid-'80s or something, when there were only a handful of firms. It used to be called TVI, Technology Venture Investors. And TVI crushed it. They were the first and only private money in Microsoft. Dave Marquardt, the founder of August, was on the Microsoft board for 34 years. They invested in Compaq and Intuit and Atheros Communications and Symantec, and they just crushed it. And then I think in 95, one of the partners, a guy by the name of Bob Cagle, and this is secondhand for me, I wasn't there at the time, but I think Bob Cagle was one of the partners, and he wanted to start a firm and invest with some of his friends, do some consumer investments. The internet was rising at the time. And so he left and literally went upstairs on Sand Hill Road and started a firm that is called Benchmark. TVI renamed to August Capital after his departure. And yeah, it was just a great firm, great legacy.
What did you learn there?
Yeah, I think one thing I learned is venture, like any other industry, goes through changes. The industry is changing. Venture firms are innovating themselves. Back in the 90s, early 2000s, there were half a dozen or a dozen of venture firms, and founders used to go up and down Sand Hill Road and ask for money. It was very clubby at the time, much more collaborative. And then, the industry changed, and, Mark Andreessen started, and Ben Horowitz started, Andreessen Horowitz, and they had a very different model, and they were trying to innovate.
Do you consider that as like a second stage, like an entirely different era?
Yeah, around that time, early 2010, you could start to see the venture ecosystem changing and innovating. Founders became much more powerful, or the balance of power definitely shifted in favor of founders during that time period. And a lot of VCs didn't realize that. They thought that, they still held the keys to the kingdom. And in reality, founders started to have a lot more options in deciding what type of capital to take, what type of people or firms they wanted to work with. And as I said, I think a lot of venture investors were innovating. And one of the things I learned from that experience is you need to change and you need to innovate yourself. And what worked, 10 years ago may not work today. And unless you have that open mind and willingness to evolve and change your business with the industry, you're going to find yourself, becoming less and less relevant all the time.
I think one of the big investments you did at August was GitLab. How did that come about?
Yeah, so I alluded to having acquired Heroku when I was at Salesforce. That was my first kind of foray into the DevTools ecosystem. And Heroku was like, for the most part, like an application hosting platform built on top of AWS that made it easier for founders to build and deploy their software. Better
Kind of
UI.
like backend as a service almost.
Yeah, easier than go natively on building on AWS. And it seemed to me at the time after we made the acquisition that owning the workflow, the developer workflow, and combining that with the application deployment and the hosting was a really good combination. And so at the time when I was at Salesforce, I was going around talking to the leadership team and the Heroku team that maybe we should consider acquiring GitHub as well and combining GitHub and Heroku into one developer platform that holds the workflow and the application, the full application lifecycle. And that didn't go anywhere. I was still kind of excited about it, but didn't really go anywhere.
Was there a pushback to it or?
Yeah, there was pushback. There was just no interest. I couldn't get any traction with that strategy or idea.
GitHub had no revenue at the time or something?
Tiny. They were maybe like a $3, $4, $5 million revenue company. This is like 2011, 12 timeframe.
Okay.
Right? And we didn't even have real conversations. I don't think I ever met the GitHub team.
Oh, so it didn't even get that far.
It didn't even get
we're
that
not
far. They're just not interested.
Yeah.
And so when I joined August, we had actually met the GitLab team about a year prior when they were doing the Series A, and we had passed on it for a wide variety of reasons, like open source, distributed team, a developer tools company. Developer tools used to be a shitty business.
Yeah, because they used to not make money, right?
And it was a tiny TAM. The reason developer tools were a shitty business is your customers were basically just tech companies, which is not that big of a market, or it used to not be a very big market, right? And then with the cliche software is eating the world that Mark Andreessen coined, which actually is quite profound when you think about it, but like you kind of realize that the vector of competition, kind of where all industry was going to compete going forward, regardless of what industry they were in, was going to be at the software layer. If you're an insurance company, you're going to compete. Like, you're not going to build a better, underwriting, whatever model, better actuarial model. Like, that's not like where the vector of competition.
But you might make like a better consumer product that like captures new customers.
For sure. Better analytics, better like whatever drives your business, better insight into customer, better opportunity to upsell, like whatever.
That was all software.
If you're like Caterpillar and you're like building industrial equipment, you're not going to like compete on better quality of steel or shovels or engines or like whatever. Like, that's all commodity at this point. The vector of competition was going to become what software and services you can wrap that equipment with. And so all industry, kind of my thesis was that the market for dev tools is going to expand 10x, 20x, 50x over the next decade. And therefore, developer tools are actually going to move from being a niche business, small TAM that was selling mostly to tech companies, to really having the keys to the kingdom and being able to penetrate and monetize selling software, dev tools to all industry. And so with that kind of backdrop and like thesis I had, when GitLab came about for the Series B, one of my partners, Trip Jones, pinged me and said, "Hey, Villi, like GitLab is coming for Series B. We looked at it last year. We didn't know what to make out of it. Would you want to take a look?" And so I was like, yeah, sure. I like that space actually a lot. I have some background here. I want to meet the founder. And so I remember having the first meeting with Sid at GitLab. And after the meeting, I turned around to Trip and I was like, this is actually really interesting. There's a lot to like here. GitHub had a lot of weaknesses at the time. After the acquisition of Microsoft, I think they put it in another gear and Microsoft cleaned up a lot of their problems. But GitHub was a really mismanaged company, right? They had all kinds of cultural problems, all kind of employee churn problems. They basically stopped shipping software. I don't think they shipped any software for like 2 years. I mean, just shocking. They become so dominant, but so complacent, such a mismanaged company in one of the best neighborhoods in the ecosystem. They were arrogant, right? They thought they were very slow to build an enterprise product. And it turns out the enterprise customers really cared about being able to manage their software application stack in their own environments. Now, we're not talking about on-prem anymore. The question is, do you want to buy this application and run it in your cloud? Or do you want to buy it and I'll run it in my cloud? So it's all cloud. The question was, what cloud do you want to run it in? And it turns out a lot of these enterprise customers wanted to run this, dev tool stack, their, version control and all the other tooling they had in their own environments. And by the way, software was their core IP. So the last thing to move to the cloud was going to be their IP. People may have been willing to move their customer contacts and other things in the cloud, but the IP, their software, was still very, very important to them. And in their own cloud, they can now decide policy, security, etc. Like there were a lot of benefits. And so GitHub was very slow to roll out their enterprise offering. And it wasn't that good at the time. The feedback was actually really poor. And so when GitLab came about, they started as an open source company, which by definition, the customers, were downloading the application, running it in their own environment. So from day one, because they were open source, they were being adopted actually in enterprises. And because it was open source too, they can leverage the community to build a much more horizontal developer tools application that kind of spanned across the entire stack. They have the security, the CI/CD tooling, all of that, not just the version control. And so that also appealed to all of these companies coming out of industry, right? In tech, if you're a tech company, you spend the last 20 years kind of building your own best-of-breed tooling. If you are some bank or insurance company, industrial company out of the Midwest, software is new to you and you're kind of looking not for best of breed. You're looking for something that kind of works end to end and can get you there 90% of the time. Maybe one day you're going to focus on best of breed tooling. And GitLab may have not been the best product for any individual component or tool inside the large stack they built, but it was end-to-end CI/CD platform from, the issue tracking, tooling all the way to the deployment features they had.
So there's a lot of different disparate kind of dev tools.
But all integrated into one platform. One of the things I got really excited about is seeing the traction they had outside of tech companies. Customers used to be like ING Bank and, and agencies. National security agencies were using it in their own environment. Nobody knew how they were using it. But that's kind of part of what excited me. So you look at GitLab, you have, a fairly narrow competitive set. You had Bitbucket, owned by Atlassian, and GitHub. Bitbucket wasn't doing well. GitHub was not a well-managed company. And GitLab. And I thought GitLab actually had a really good opportunity in that, in that competitive landscape, but also a great neighborhood. Back to my thesis, I thought the demand for dev tools is going to expand exponentially over the next few years. And to me, that was just a really obvious bet to make. And I was very fortunate to kind of build a relationship with Sid and be able to lead that Series B round.
How'd the investment go? Was it a good one?
Oh, I mean, it was one of the best software investments, ever. It's just the type of thing that you're lucky if you have once in your career. I remember joking with my partners. It was so obvious to me. We can talk about that. Sometimes things are just so obvious to you, but maybe not to others. And sometimes, a great opportunity can hit you over the head and you still don't recognize it. It's really funny how venture works. In this case, it was so obvious to me that I remember telling my partners a month after I made the investment, I'm like, guys, you should go ahead and fire me now because I don't think I'll ever be able to do a better investment than this. And that's done. So like, I don't know where I go with my career from here because I think I just made the best investment in my career. It was just so obvious to me. And it's not always the case. I'm not trying to pretend to be smart. There are things that literally I remember seeing Snick, for example, just a year later. And I saw it at the seed, I saw it at the B, at Sim, introduced me to the company. He was a seed investor there from Bold Start. And that thing could have hit me over the head 6 times, and I still didn't quite get it and see it. And so, sometimes things are just like so obvious to you, and sometimes great opportunities are so hard to grasp. It requires a unique, prepared mindset. People talk about being contrarian. I don't like that concept of being contrarian.
It's like the most consensus thing now. Is that
it's
you have
so
to be contrarian.
I find that to not be a particularly helpful mindset. Most of the time when you're contrarian, you're actually dumb. There's wisdom in like
not making dumb decisions.
Like, the wisdom of like people, there's value to that. Like, so just being contrarian to be contrarian to me is not particularly helpful. But I do think having a unique perspective, a unique mindset, a prepared mind, a point of view on like where the puck is going or the future. And when you see the opportunity, kind of putting that together, I think that to me, that is really what people describe as contrarian, not just going the opposite direction of where the crowd is going. I try to look at places that are not where the crowd is going, but not to be contrarian, mostly because I think people will overlook opportunities there, and I probably will find good investments.
You want to find the things that are going to be consensus in a year or two. Like that's probably the ideal as an early stage investor.
Sure.
Yeah.
So that's how I ended up getting involved with GitLab, and it was just an amazing company.
You mentioned though, like the company, like it almost didn't work. Like it almost like collapsed at some point. Like what was the extent of that?
I mean, there were many moments where things could have gone in a different direction in the life of the company. I remember about 4 or 5 months after I invested in GitLab, they inadvertently deleted customer data. Think about like your software code, your IP of customers. They deleted and lost some, like one of the databases failed. And that's the type of thing that will kill a company. Like if customers cannot trust you with their IP, like what business, like trust.
Job they were fulfilling, right?
That trust is your number one, objective and kind of priority when you're building many of those enterprise customers. Once you lose customer trust, you're done. And they had this database failure. And what Sid did that was absolutely brilliant at the time is, in the spirit, they've always been a very public company, right? They published their roadmap, they published the employee handbook, they published everything. Everything was public. Everything they did was in the public domain.
And this was as a early stage startup or mid growth stage startup too.
But they were an open source company and they believed in transparency, and they had everything was public. Their roadmap was public, so a non-employee could contribute to the roadmap of the company, and they can choose to accept or decline that feature. But like everything was public. And so Sid decided to broadcast on YouTube how they were dealing with the recovery. And so in real time, as they had this massive database failure, they put a YouTube stream for like how they were troubleshooting and resolving the issue. And it became a massive thing. I remember like employees from, like a manager from Google basically tell their employees, like, shut down whatever you're doing. The best education you can have on like disaster recovery right now and what to do when shit hits the fan is to watch this YouTube stream. And so people from the entire industry actually ended up like watching how GitLab was dealing in a very public way with this database failure. And so
wouldn't it be embarrassing though? Like you're going out there, like admitting and talking to people. Like, how do you get over that?
But that's the point. There's nothing embarrassing about it. Like, software is fragile. Everybody makes mistakes. What sets people apart is like how they deal with those, how they recover, that, again, back to building trust with your customers, right? That's so important. And so that, like, the company, not only did they recover from it, the way they handled it allowed them to build a ton of trust with their customers.
I think they emerged with even more trust than when they went in.
That's exactly right. That's exactly right. And even though competitors would like market against it and throw FUD, I think the way they handled it allowed them to emerge stronger as a company. So yeah, I mean, there were always bumps. In retrospect, kind of look at the trajectory of GitLab, you would think that everything was linear and up and to the right. But if you talk to Sid, you kind of know, like, it's never easy. It's never up and to the right. There are always moments in the company's life that are transformative and have the opportunity to take you on a very different path. And yeah, they built a great company, but it may seem like it was an easy journey or a quick journey from the outside. It was actually a lot of hard work and navigating challenges like that came about very well.
Yeah, you mentioned Guy and Sneak too. I had him on the show a couple months ago. We'll link that one in the show notes if people want to tune into that one. But they had a similar, like, I think today, I think they announced publicly, I think I saw the number was 300 million in
something like that.
Like,
that sounds right.
Significantly large.
Yeah.
But yeah, he was telling me stories like, we had to do multiple bridge rounds, meaning like wasn't clear that this was working.
Yeah.
Like,
as I said, I saw it. It could have hit me over the head 6 different ways, and I still didn't quite grasp the opportunity. There's a little overlap with GitLab, so there was a little bit of a conflict too, and so I wasn't sure. Like, I didn't want to put myself in a position of conflict, so I had to be a little careful. But I won't pretend.
It's easy to say I would have done it.
That I fully grasp how great of a product they were building.
So you were at August, you spent some time at a firm called 2 Sigma. Maybe touch really quick, like, how did that transition happen? And then obviously started your own fund recently.
Yeah, so when I left August Capital in 2019 in the spring, I was a bit lost. I guess the first question I asked myself was, do you want to stay in venture? And that was a pretty quick answer in that I was happy. I was enjoying what I was doing.
Seemed like you were pretty good.
I felt like I was doing a pretty good job. So I kind of finally found this career that my skill set, my interests, what I was good at were kind of coming together for the first time. And I wanted to stay in venture. And then the next question is, what's like the right thing? Now you're a little wiser, you're a little smarter. Like, what's the right opportunity where you can become join a firm and thrive for the next, for the rest of your career? Because every opportunity in venture you should think about as your last job. If you have to change jobs, you have probably failed in venture, because the payoff on anything you do takes at least a decade, in some cases 2 decades. Right? It's not like anything I do today leads to success within a year. Like, the way these funds work is like, maybe, you make money after 10 years or 15 years. It just takes a long time.
You just basically teed it up as like you failed because you're leaving.
Well, kind of. I mean, I think, August stumbled and had some challenges at the time, People have written about that. I don't need to regurgitate that, but we had a hard time raising our next fund. There was, not full alignment on like where the firm was going or how we were going to be successsmart going forward. And so, yeah, I had to leave.
Was there anything you did that was strategic or very smart, like smart decisions you made in terms of like setting yourself up to join 2 Sigma and then start Category?
I realized that there's really nothing clean in venture, short of joining, Benchmark, regardless of which firm you join, you're going to make some sort of a compromise. You're going to compromise on brand, on reputation, on access to capital, on culture, on values, on stage, on economics, on title. You're going to compromise on something, right? There's really nothing clean.
Never a perfect
There's
pitch.
never a perfect fit. And so the question I faced was, what do you want to compromise on? What are your values? Like, what do you really care about? And I was fortunate to have the opportunity to join different firms at the time. I had done a few good investments. People thought I was capable, but like I had to decide like, where do you want to go with this? And, in joining Two Sigma, I kind of bet on myself. The compromise I made was brand, right? Two Sigma Ventures was not, well, Two Sigma is known to be a very successful hedge fund, and it's known in the financial industry circles. But Two Sigma Ventures in the tech ecosystem at the time was not a well-known brand. It's not like if you ask a founder, give me the top 10 venture firms. It's not like Two Sigma Ventures will come up as like one of the top 10. But I was confident. I was thinking, I don't need the August Capital brand behind me. I can join Two Sigma Ventures and still be successful and bet on myself. It was set up the right way, good people, good team, the right alignment. Everything else was set up the right way. And it felt like a really good fit where I could have an impact and actually put Two Sigma Ventures on the map and make it a firm that people know about. And I would argue, 6 years later or 5.5 years later, I would say Two Sigma Ventures today is a much better, well-known firm as an early stage investor than they were when I joined. And so that's what led me to Two Sigma Ventures. I had an amazing experience there, great team, really good team. One part I omitted in that process of thinking what I wanted to do next, I actually thought about starting my own firm. I didn't have the confidence or the courage to do it. I was in a different place.
Really?
Financially, with life. I was still a relatively nascent investor. My track record was not mature. I didn't have the confidence. I didn't know if I can go on my own and start a new firm. I had a couple of conversations. I couldn't afford not to work for a year or two getting this thing off the ground. And so I decided to join another firm and not start my own. That idea of starting my own firm didn't go away. It was always kind of in the back of my mind. And then I would say earlier this year, that voice in my head started to get louder and louder to start my own firm. The opportunity I was seeing became more and more clear and compelling. I had matured as an investor. My track record had matured. And I thought, I don't know that I can pull it off. I don't know if people will believe in the strategy or the firm I want to build or be willing to back me. But I knew that if I didn't try, I will regret it. I knew that if I didn't go for it, if I failed, I would have been fine.
Just because you took a shot.
I could join another firm. I would be fine. I could go do other things. But I knew I would regret it if I didn't explore it. And, my kids had grown up. And so I talked to my family. I was like, I think I'm going to quit and kind of turn things upside down here for a few years.
How tough was buy-in just from your family?
No, they were very supportive. Like my wife especially, she's like, Villi, like, we'll be fine. Like success or fail, or succeed or fail, it will be okay. Like we'll be fine. So if you're excited about it, go for it. Don't worry about it. Like the family will be fine. And yeah, so they were very supportive and kind of nudged me. And my kids too, like, raising kids and teaching them values and stuff like that. As we talked about it, it occurred to me in the middle of it that, they're the age now where if I fail, they will really see it. They're going to kind of see the whole process and everything I went through. And that will actually be a really good lesson for them, right? I actually
understand what's going on.
They'll understand like how I tried and how I failed. And to the contrary, like the opposite outcome, if I tried and made that leap, and after these conversations, they kind of saw me working on it and thinking through it. And I did end up being successful. And by the way, raising a fund is not success. Like success is like,
you got like the first step of many steps done.
Right. Like I just got started. But like I want them to see that too. Like the process, the preparation, how you spend years kind of putting the pieces in place so that one day when the opportunity presents itself, you can take advantage of it. Yep. So I want them to see that too. So in a weird way, there were a lot of things going on in my life where I'm like, now is the right time. I see the opportunity to take advantage of it. And and so I resigned from Two Sigma Ventures in April and started working on this new idea I had for a new firm called Category.
Yes, you said you saw an opportunity. What was the opportunity that you saw?
The opportunity I saw was, as I had looked at the early stage ecosystem, my impression of it, and certainly people debate this, I don't pretend to be right on this, but that was my impression. That's my thesis. That's my view of the world. Was early stage is incredibly fragmented, incredibly competitive too. There are lots of players that dabble into the seed stage ecosystem, but also there are very few brand named firms that people think about when they think about like seed stage investing. There are lots of really good investors and firms that have assets, fund sizes that are 30, 50, $80 million size that can't really lead around, right? They're in the business of writing $250K checks up to $1.5 million and leveraging their expertise, their network, their insights, and trying to get themselves in the middle of something interesting. There are actually very few C-stage firms that can write a check that's like, $2.5 or $3 million. And so what struck me is that the industry operates in a subscale way, right? Even the more established seed funds are still operating with the mindset of we're going to write $2.5, maybe $3 million check into $3 to $4 million seed rounds and kind of get like 12% ownership. And some of the market is that, but some of the market is, second-time founders, experienced operators, scientists, researchers, engineers, starting, looking to raise seed rounds that are $4, $5, $6, $7, $8 million seed rounds. And I'm not going to talk about the other crazy rounds that are getting done now. But and they're raising these rounds oftentimes for the right reasons, like especially in infrastructure and AI, it takes a little bit a bigger team. You just need more time to build something useful. And for those types of rounds, founders have two options. They can go to the seed stage ecosystem and cobble together a syndicate of these firms, which takes a lot of time. You need to align all of these firms, give them the right amount of ownership and piece of the pie. It's just not as an easy process because you're dealing with multiple investors. The alternative is you can go to the multi-stage firms, and that's an easier path, like you get your round done. But I fundamentally think they are the wrong investor for a startup at that stage. They can write you a $4 million check or $5 million check, but you're probably dealing with a junior partner who has very little experience investing or otherwise, who may or may not be there in a couple of years to support you. If you're dealing with churn is very high in industry. If you're dealing with a senior partner, let's be honest, they're on 15 boards. They're busy people. That seed check they just wrote is the last thing that they want to spend their time on and mind share on.
Well, I mean, why not? It's the sexy new thing. Wouldn't they want to spend time on it?
They don't, as I said, they're busy. They're buying an option on your company. That's the whole point. These larger firms are in the seed business. They're buying a bunch of options and the ability through that option to deploy capital
and that's
over
because
time.
They think, all right, we'll give this person $3, $4, $5 million, and if it works, we get to do
we get to deploy 50 or 200.
Yeah.
If it doesn't move the needle on the fund. And so they're just not the right partner for founders at that stage. But founders go there because it's a lot easier. The brand matters too. A lot of kind of younger, less sophisticated founders gravitate to larger brands. But it's just not the right product. And so what occurred to me is like there are actually very few options for these founders. Like there's really no brand that exists out there that is enterprise software focused, dev tools, infra, AI apps, enterprise software focused, and has significant flexibility around the type of rounds they can do, the types of checks they can write. You can lead a seed round with a $1.5 million check. You can lead a seed round with a $5 million check. Like this is the firm that leads seed rounds, regardless of what type of round you're looking to raise. You're the right partner and have kind of the enterprise software expertise to support them at that early stage. And there are a few firms like Amplify has done an amazing job. I was largely inspired by what Ed, Sim, and Elliot have done at Boldstar. They've built an amazing brand in New York that is serving those types of founders. But I think there's definitely an opportunity for another half a dozen firms to emerge in this space and serve founders better than the way the industry serves them today.
So you think there will be more?
I definitely think so. I think in 5 years, they're going to be, 7, 8 of these seed funds focused on enterprise software with fund sizes that can support and lead just about any seed round.
It's bad for you, isn't it? Because there's more competition for you.
Sure, but
is it like just an inevitability?
That's just competition. I think how we as VCs say that they always come in batches when we see startups that are kind of more or less doing the same thing around the same time. And my response to that and insight is that's not an accident. That is just the efficiency with which founders spot opportunities in the market and take advantage of them. So yeah, it's not an accident that we constantly see batches of startup in and around the same idea or space. That is just the efficiency with which opportunities are spotted by the ecosystem and founders. So, that's life.
So one interesting thing you mentioned was, you mentioned it to me in the past. You've said that being able to kind of use your track record in raising this very first fund. Can you just kind of explain just the importance of that and kind of how that played into raising the first category fund?
Yeah, track record turns out is a really important thing in the world of venture. And a lot of younger investors that get into the business don't quite have the understanding of why or how it is important for their career going forward, especially if one day they want to start their own firm. And the issue here is it's complicated. So let me start with success has many parents, right? When a startup becomes very successful, it's really hard to discern who should get credit for an investment. Everybody will take credit for an investment. And of course, with failure, everybody runs away from failure. So nobody wants to take credit for that. And so, firms tend to be fairly guarded and opaque about who should take credit for investments. A lot of that information is proprietary. And so a lot of the challenges that, VCs leaving their firms face, especially if they want to raise external capital, is showing to their prospective investors, to LPs, that they are actually good investors. And so both the attribution, like who did this deal, but also was that a good deal? The data behind it, that is proprietary information. And you cannot share that type of information unless you have explicit permission from the firm to share that type of information. And so being able to have the right to your track record, to be able to use it going forward is really important. And, the August Capital team was very kind to me and I wasn't entitled to it. They didn't have to be nice to me, but they were very kind and supportive of me, and they were willing to share and give me the ability to share my track record with prospective investors. But actually, because I had gone through that experience and I had realized how important it was, I also, prior to joining Two Sigma, I had also explicitly asked that I have that right going forward. For example, if I'm fired, maybe I don't do a good job, I get fired, that's fine, but I do need to get another job after that, and being able to tell people what I did and what I accomplished when I was at my prior firm is really important, or start my own firm. And so I had the insight at the time to know to ask and negotiate upfront to have the right to my track record. And for the VCs or aspiring VCs that are listening to this, I can't emphasize how important this is going forward for you to ask upfront to have the right to your track record going forward, because some firms are not very nice on the way out, and that may make it very challenging for you to move on with your career, start your own firm.
I think I have two questions left before we kind of break. One of them was from mutual friend, Nakul Mandan. One of his questions was, how did you decide on the fund size? So you've kind of hit on this a little bit, but I think I saw there was like a Wall Street Journal headline that was 156 million or something. I think that's a pretty specific number. So it sounds like, how did you plan this all out?
That was, so the Wall Street Journal basically picked up on a filing that I had made. I didn't announce the fund. At the time, I didn't comment. They just picked up on a filing that I was legally required to make. And the filing basically said that I'm raising 156. I wasn't raising, I had closed on 156, but I wasn't ready to announce it yet. And there was like additional capital, but that was like the number that I was legally obligated to put in the filing. And so actually the fund ended up being a little bigger than what I was targeting or hoping to raise. Still within like line with what I wanted to do. But the way I thought about it was, it's basic fund math, right? Like, you want to have a sufficiently diversified portfolio, which basically means, call it 25 investments in a fund. I alluded to the fact that I wanted to be in a position to be flexible with check size, and have a more high ownership strategy, kind of be more involved, like really engage with my founders, not spray and pray. But, I don't get excited that often. And when I get excited, I want to invest as much as I can. I'm not looking to buy options. I'm not like, I like this space, so I'll make 5 bets in a space. I want to bet on the one company I'm most excited in a space. And when I find that, I want to own as much as I can. So, I wanted the firm to be able to write $1.5 million checks. I wanted the firm to be able to write $5 million checks. And so I was like, I don't know what I'll average, but let's say I average $3 million per investment on average. And I want to have 25 investments in a fund. And you kind of do the math, and you're like,
follow on,
and you want to be able to reserve, enough capital to support that portfolio. So I thought that's a $150 million fund, approximately. And so that's how I set it up. It was the strategy. And this is what I tell also people that are looking to start funds. Don't set a target for your fund based on what you think you can raise or some other kind of factor that leads you to that number. Let the strategy dictate the fund size you need. And that's how you pick the fund size. Like, if you want to lead, you don't want to be a lead investor, and you want to write, your strategy is thematic. So I'm going to be thematic. I care about these 5 spaces. I'm going to invest in a bunch of startups in that space, but I'm not going to try to pick the winner. I'm just going to invest thematically in areas that are of interest to me. And I'm going to write 500K checks, and I'm going to make 40 investments. Do the math on what fund size is required to support that strategy. And when you raise, tie it to your strategy. And so the fund size that I came up with was not like, pick a number, here's what I think I can raise. It is, what am I trying to do? What's my strategy? What kind of fund size do I need to, execute on that strategy? And that's how I came up with that fund. And so the fund is $160 million at the end of the day.
And you mentioned something interesting with being able to follow on. So whether these are like exciting follow-ons or bridge follow-ons, you have $160 million. Might be another fund that has $3 billion, and they could easily bridge some of these rounds, follow on more over time. Is it more likely that I'm going to get a bridge round from someone like Category and you, or from a bigger fund?
This is a great question. This is a great question because I think founders don't realize kind of the impact of this and what it means to raise capital from a large multi-stage firms at seed versus, a seed-focused fund. And the assumption is what you articulated. Well, they have a lot of money. Therefore, if I hit a bump and I need another $1, $2, $5 million,
it's just a small check.
It's a small check, no big deal. They're going to support me. And it's actually exactly the opposite. It is exactly the opposite. The large firms, more or less, as I said earlier, they're buying an option on your company, right? If it works and it works quickly, they can deploy more capital behind it. If it's like hard and it takes a long time, they want to move on to the next thing. They don't have the time, the bandwidth to like mess around, spend a lot of cycles, work with a founder who's like had to pivot or had to do some other things. And it's kind of working, but not really. It's not ready for an A. Like they move on. They are moving on. I see it all the time consistently. Like those firms are gone. And now you have taken capital from a very large fund and you need a bridge and there is no place to get it. There is no place to get it. A seed investor is not going to be like, oh, I'm going to come behind this multi-stage fund. If they're not willing to bridge you, why should I? And so I actually think seed dedicated funds are 10 times, 100 times more likely to continue to work with you and support you and try to find a way for you to achieve that next milestone, product market fit, next round, whatever it is, than a large multi-stage firms. Those firms are just not a good product at seed. They are more or less buying options. And really that is a core thesis. One of the core thesis, part of my thesis are that smart founders who realize that trying to raise these rounds from the large funds is not the right place for them to be raising capital at seed. Those firms are great, but they're great they can do Series A, B, C, D. They're in the
Some
business
of them invest after you're public too.
They're in the business of deploying capital. They're in the business of managing funds.
So it's really a good way to think about it is the smartest founders want investors where their business is also a material percentage of that investor's business as well.
For sure. Like even when I was raising my fund, I went to ask some of the kind of thoughtful OGs, early stage investors, and I had no idea. Should I have 10 investors? Should I have 40 investors? How should I think about it? And their answer was the same. It's like, Villi, you want to surround yourself with people that care. Just like you think about ownership, they care about ownership. You don't want to spray it across 40 investors. You want to work with a few investors where this is a meaningful investment for them, that they care, they follow you, they track you, they help you, they support you. And I think the same thing applies to, founders, right? You want to work with people where the check you're taking is important to them, that they care. They're not going to be loose with their decision making and let it go prematurely because it's a rounding error in their fund.
Well, speaking about people, so I think you've kind of mentioned you've changed the way you maybe think about things. Where there's a lot of investors that are market first. There's other investors that are maybe people or founder first. How do you think about that, or how has it changed for you over time?
I don't think that way. Things come together for me, but I look for all things to come together. I don't like the idea Though having said that, I did it with Howie, obviously, with Airtable. But if it's like an amazing founder like Howie, like I'm happy to back them regardless of what they're doing. But that's rarely the case, actually. It requires for you to know this person really, really well to have that type of confidence. And they're like great markets, but there are a lot of great opportunities in markets out there. That doesn't mean that this team is going to be able to take advantage of it. And so markets matter. Like, yes, as Elad Gil says, like, I would rather be an investor in a, average team in a great market than an exceptional team in a crappy market. Yes,
you want great team, great market.
Exactly. So where I'm going with that is like, I kind of need all these things to come together for me. I'm not just looking for just founders. I'm not just looking for founders or products. Things are hard. Things need to go your way. And for me, like looking at like, is this the person to take advantage of this opportunity? Is this opportunity the opportunity I want to be an investor in? Things need to come together. And it's not formulaic. People like to make it like some sort of a formula where if you score 4 on these 4 dimensions, it's an investment. And if you are 12 out of 15 points, it's below. Like, I don't think that way. So, I try to judge every opportunity on its own merits, every founder on their experience and their merits and their ideas and strategy and personality. So I don't have a formulaic answer. I don't like investing in a formulaic way. I try to make up my own mind and look at everything in isolation. Obviously, trying to draw from my experience, but also trying to see if things come together for this one.
Yeah. Well, this is an awesome conversation. I had a lot of fun. Just really quick, where can people find you? Like if they like this, they want to look you up.
Oh, they can find me anywhere on Twitter at Villi. My name, fortunately, is not common. So easy to find me. Yep. On LinkedIn, though I'm still recovering from the literally, I think I have like 1,000 unresponded LinkedIn messages.
Because you kind of announced it.
And it's just, so LinkedIn is probably the last place you want to look me up, but Villi at Category VC, Twitter.
It's categoryvc.com.
Categoryvc.com, Villi at categoryvc.com.
We were just talking about the website that you worked on that took forever.
That's, V1. And
are you going fancy website or plain website?
Pretty plain website. Pretty plain. I don't think I'm in a business where the website is going to meaningfully change how founders perceive me. But, you want to launch something informative and useful that basically articulates to founders who I am and what we're working on. And actually, one thing I want to end on is I started this firm by myself. And actually, a lot of the advice I got from friends and investors was to do it on my own. But I don't want to do it alone. I don't want to be alone. I think venture is a very lonely business in many ways. It's a social business. You talk to a lot of people, but it's lonely. And so I do want to build a team. I want to build a great team. I want to surround myself and hopefully for Category Ventures to continue on after I'm done. So over the next, few months, I'm hoping to add to the team and surround myself with people better, smarter than me in every way. And
what are you looking for? What would be the ideal?
I'm looking for highly technical investors that are passionate about working with and supporting founders. But I want the firm to differentiate around being highly technical.
Okay. So I think you mentioned all the places people can find you. So if that sounds interesting to you and you're listening, you should definitely reach out.
Yeah, ping me.
Cool. Well, this is a lot of fun. Thanks for doing it.
Thank you. Appreciate it.
And thank you for listening. If you missed it, make sure to check out last week's episode with Rahul Sidhu, who shares everything he learned building and selling 2 companies in the public safety space, the second one in less than 2 years. If you like this episode, please leave a quick review or comment wherever you're listening or watching. Check the show notes for more on the topics mentioned throughout the conversation. And if you don't want to miss a future episode, subscribe to my newsletter, The Split, to get each episode plus a transcript emailed directly to your inbox every week. Thanks again for listening. See you in the next episode.